Welcome to Investment Talk Only with Johnny Ruiz. It's time to get to the money. It's investment talk only. If you say you got the money, gotta show me. A lot of people talk, but that be phony. I just remember what Jerry Mack told me.
I love that we have a hip hop intro to the Investment Talk podcast. It's like the coolest thing.
It's like perfect.
So I mentioned him, this guy before. I don't know if it was the trailer or episode 1 or whatever, or maybe I didn't mention him. But Mark Monroe. That's it.
No.
Oh, so Mark Monroe, he created this following on YouTube and Instagram. I definitely suggest everybody follow him. He just drops gems all the time.
About what?
About investing, just from top to bottom. Just I won't say from top to bottom because he thinks you have some knowledge about investing. And so if you want like what is a stock, he's not going to give that to you. He's more like you already know a little bit, and then he'll give you a lot more strategies to events. But
It's like intermediate type.
I wouldn't even say intermediate, just like and maybe like you just don't even know where to go from there. Like you already have the basics down, and then like I guess that is intermediate, but yeah, I guess it is intermediate.
Yeah. That's that's intermediate.
Yeah.
It's okay. No, that's perfect because.
But hold on, so his following is called the Cousins. All his fans, like, because they make it like a family thing, like a family vibe. So we're all cousins. So all his fans are cousins, and so they make this Facebook page. They have 2 Facebook pages. One is the Cousins of the Come Up series, and then the other one is Financial Wakanda. So
Financial Wakanda.
Wakanda, yeah.
So it's like for the culture, like.
Yeah, for the culture. So that's what I thought of. That's what I think of when we playing our. So like we're doing it for the culture. So Financial Wakanda, hip hop intros. Let's go.
Oh, okay. So we're gonna do like a little in the beginning, or.
Nah, I'll say that for you. We could do that one.
Wakanda. Okay. So basically this episode's gonna be about investment 101, right? So because that's what the podcast is about. Mainly it's all about, getting your money right, but a lot about investing. So let's start from the basics. So a lot of times when people hit me up, they're like, I want to invest. Like, it's the first thing they say. They're like, yo, I want to invest. That's it. And then they're like, well, what do I do? Like, how do I even start? And I'm like, well, first you have to do get a brokerage account. Like, I'm not an expert, but I know a little bit. I'm on like the basic level. So I'm like, yeah, you get a brokerage account, which is what you explain in the explainer, right?
Yep.
So, and then they're like, okay, so what about, then what? You pick a stock and then you just see the numbers going up. I know a lot of people, it's like a little bit confusing. So can you just walk me through like, all right, I made a brokerage account. Now what do I do?
Well, I think we still got to go even before that. So we made Guns and Butter, and that was kind of getting the mindset of even like wanting to invest, deciding that it's kind of a wise decision to invest versus purchasing other assets.
Okay.
Or not even assets because it's just purchases. So you made a decision. There's a few ways to go about it. So yeah, you can make your brokerage account and then control it yourself. Like if you know investments or you want to learn more and you want to be more hands-on, you could do a self-directed account. So you will open a brokerage account, but when you open a brokerage account online, they're going to give you like, so you want to open something up, but which one? And it'll be like 4 different options. So one of them is the self-directed one where you kind of want to, do it hands-on yourself. That's my realm. I don't want anybody making my decisions for me. You can go to a financial advisor, which is a good decision as well. A financial advisor. Mm-hmm.
Hold on for a second. So the financial advisor, do you automatically like, oh, I know this financial advisor, I want him to manage my stuff, or does the brokerage account it like assign you a financial advisor?
Yeah, so a lot of people, some do it differently. So if you know
Mhm.
a financial advisor and you trust them like personally, then obviously you get to pick them and they'll work with you. A lot of times, if you just call into the like a Merrill Lynch or a
Mhm.
Charles Schwab, one of those brokers, yeah, they'll just assign you uh, a financial advisor. It's not really your
Okay.
choice. Um, I guess you have preference if you really want to, like, hey, I want somebody with 20 years experience or something like that.
Mhm.
Um, so you can go that route.
Okay.
All right. So going
So
to,
if you knew if you knew the financial advisor and you picked them personally, so for example, like me to you, you're my brother, I trust you. So is it like you have a financial advisor, you just give them your password and boom, and they're in your thing, or is there another way to go about it? Do you sign contracts? You do
yeah,
because
so
that's something I
so they usually were, no, so you don't give them a password. So you're giving them discretion to work your account, your money. So they have full access to your account, without you
okay.
being there. So you give them like, I don't know, like $5,000 to say, hey, I would invest this for you. You got to trust me that I'm going to do the best for you. And so there's a term that goes
Mm-hmm.
with that. It's called fiduciary responsibility. So we're saying they're going to act in the
Okay.
best interest for you and not for me or the company. So you give
Mm,
them that confidence or that power to make those financial decisions because they're the expert and you're not. Um,
okay.
so yeah, so you can go the self-direct account where you just make a password, like you say, username, password, and you only have access to it. You can go to a financial advisor and you're saying, just here, take my money. And you could have access to your account online, but you can't really do anything on it. And then you could call them and say, hey,
Okay.
how's my money doing? Blah, blah, blah. And they'll say, oh, it's growing whatever percent. Um, so that's how actually you get started. Is either doing
Okay.
it yourself or getting somebody, a professional, to do it.
And
Now,
this is for stocks only. This is the stock market investing,
yeah, stock market investing, yeah.
correct?
So I invest in the stock market. So
Okay.
yeah, that's kind of my expertise. So that's where we go from there. And so you can do open like a regular account where you're just gonna invest, your money that you have sitting around. But if you want to
Hmm.
have money for retirement, that's a separate account. And
The
then
IRA.
yeah, the IRA, or you can
Okay.
do a 401k as well. And then you have a separate account like if you want your kids to do education or whatever. So you have money for
The
college
520.
and it has like tax benefits. So yeah, 529. Yeah.
Okay.
And so
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 you
yeah,
so
you have different options.
I do have a question for you. So you named all these options, right? So say you have just say $10,000, right? Is it smart to split it up like 2,000 in this type of account, 2,000 in that type of account, 2,000, or is it smarter to just put a larger sum and all in one account, the whole 10,000, so you can get a higher um like gain? Does
Yeah,
that make
well,
sense? What I'm saying?
yeah, it kind of makes sense. So if you have 2,000 split 5 ways and they all grow the same rate, so you're going to get the same percentage, even if it's in what was in
Mhm.
one account. But the reason why you'll put it in different accounts is like whatever your goals are. So like I said, if you want your
Okay.
kids to go to college, then you'll put in a 529. If you don't have any kids, then
Mhm.
obviously you wouldn't. Um, or you can go to college yourself and invest in that. So it just depends on what your goals are. So that's the thing about a good thing about financial advisor is they're gonna have a
Mhm.
conversation with you about 45 minutes to an hour or so to see what your goals are, what your income is, what's your full financial picture, and they're gonna see exactly what suits you best. So my situation not gonna be the same as yours, as the next person.
Mhm.
So that answer might be good for my situation, but it might not be good for yours. So
Yeah, that's true.
even when you open a brokerage account or whatever, so let's go on a financial advisor side. So a lot of people are skeptical about the finance industry professionals, like
Okay.
for good reason sometimes. Like, some people are shiesty. And maybe not today. Maybe it was more prevalent back then, but it just has that
But
stigma.
wouldn't you have like legal documents to cover that? Some people are shiesty, but like in the contract, doesn't it say like, oh, okay, like yes, there's have to do things in the best interest of you, but obviously you're not the professional. You don't know what the best interest is.
Exactly.
So are there certain things that cover that, or is it just like you're trusting you're trusting this person with your money?
Yeah. So like, there's a whole bunch of like, uh, what is the word I'm looking for? Where it's like safety measures where that doesn't
Mm-hmm.
happen as often, especially with bigger firms. Now, if you're working with one person, then that's more risky. But with firms, they're monitoring your calls. They're making sure you're doing the
Mm-hmm.
right investments. If you do something like kind of like shiesty, the like the internal auditors, they'll be like, "Hey, why'd you do that?" Like, that this
Yeah,
client,
they're like, why did you make?
yeah, this
Okay.
client is living paycheck to paycheck. Why did you make that risky move? And they'll check the advisors. And so yeah,
Oh, okay.
there's things in place to like to check the advisors. Like they could get in real trouble. Like, didn't you hear when they said that they don't have enough money for that? So why did you put them in that? Yeah, so they do have
Oh, okay. All right.
yeah,
That's good. You have a checks and balance
yeah.
system.
And then so one
All
thing I
right.
wanted to touch on was like, so when you open, like I said, it has a stigma, but
Mm-hmm.
the best interest of you is to tell the financial advisor everything if you're gonna go that route.
Okay.
A lot of people like to hold back, like, I don't want to tell them on my business, on my bills, on my debt. I don't want to tell them about the
Until you-
80,000 like I have in debt or down the street. But
No,
in
I just be like,
order,
I don't even tell them my spending habits. That's for me. I'm like, all right, yeah, I do spend $110 do my nails and like, you know what I'm saying? Like,
yeah,
that's one of the things, and not that it's embarrassing or nothing, but you just know, it's just one of those things like, you're like, damn, I know I shouldn't be doing that, and you just kind of leave it out. Then when they calculate everything, they're like, this is not adding up, like your
yeah,
whole budgeting, like you're missing some stuff out. And then that's when they go to, it's not like they like print out your monthly
yeah,
statements and stuff.
yeah.
So
Yeah, I mean, yeah, they're gonna find
yeah.
out. They're gonna find out something's not right. The thing is, like I said, it's in your best interest to tell them everything,
Hmm.
because
Hmm.
how can they make a decision that's best for you if they don't know all the details? So it's like they're gonna put
Yeah.
you in an investment that doesn't even fit your financial situation because you don't want to tell them. So it's like going to a doctor and then tell them something's wrong, and you're saying that, oh, I'm not gonna tell them about this bleeding down here or somewhere or whatever because you're embarrassed. Like, how is he supposed to diagnose you if he doesn't know all the
Yeah.
details? So it's the same thing. I mean, that's the expert. Um, and they literally, that's the only reason why they want to know. It's not like they're gonna go home to their wife, like, yo, this client of mine, Monique, she only makes $10 every month. Like they don't really care.
Yeah.
so
I
so
feel
yeah,
you. It's like one of those things like they see your type every single day. You're just another, you know what I'm saying? Like there's
yeah,
nothing that they're cares about.
yeah. They're like
So
I
I
said,
get it.
they're like the doctor of the finances. Um,
Gotcha.
but and then it always leads up to, so one question I wanted, because I was on that side, I was a financial advisor. One question
Hmm.
that doesn't have to do with your financial situation or their thing is, well, I guess it kind of does. They say, where else do you have your money at? Like, do you have money with Merrill Lynch or whatever? Oh, how much? So one thing is,
I've had
go ahead.
And I'd be like, why do they want to know? Like, they're like, so are you banking with anybody else? And then in my head, I feel like it's like cheating, like, because I got two banks, you know? Like, oh, so do you know what I mean? And I'm just be like, oh, no, I always put no. I always put no.
Okay,
I
so
don't know why.
I will
I don't
tell
know
you this
why.
though, they do have an ulterior motive, but it's still in your best interest to tell them. So the ulterior
Okay.
motive that is that they want your money. So it's ABC always be closing. So the close is like oh, did you like our conversation? If you did, then you know, trust me. Why don't you bring that money over here? Oh,
Yeah,
the
that's how I
80,000,
feel. That's how I feel like.
just bring it over here.
Yeah, that's what I'm feeling like. I'll be like, yo, and the way, but so I'm good at reading people a little bit, right? So I'm like, I know they're trying to like feel out. I'm like, I don't know why. So I'm like, nah, they're trying to, like, I'm always like, nah, they're trying to hustle me. They're trying to play me.
Telling you why,
And
yeah.
then,
It's not a hustle though,
yeah, and that's,
because you don't lose
well, I
anything.
don't know. Now that I'm talking to
Yeah.
you, I understand what that means. So I could be like, oh yeah, you know, I have another account with whatever bank, you know? But yeah, I was like, nah, they're trying to finesse me. So
Yeah. So
I would just, yeah.
two reasons why you should even tell them that is because one, it's still, again, they need to know your full financial picture to give you the best recommendation.
Mhm.
If you got accounts everywhere,
Okay.
whatever, you gotta let them know. But the second one is, if they do tell you to ask you to bring it over here, it is best to
Mhm.
have your money in one institution than in multiple.
Why
Because
is that?
say you have a $100,000, and then
Mhm.
this financial advisor has you heavy in Apple. So 50,000 and 50,000 in two different places. He has you heavy in Apple, the Apple stock,
Mhm.
and his other financial advisor doesn't know you have money anywhere else, or even if he does, he doesn't know what you're invested in, and then he has you heavy in Apple too. So now you have
Mm.
more eggs in Apple than you really should have. So,
Got you.
AKA, you're not diversified, and the name of the game is to
Mhm.
be diversified. So it
That
is in
makes
your
sense.
best interest to tell them where your money is, how much, and what you're invested in. Because they're like, okay, well, since you're invested in, if you don't want to bring your money in, then fine. But if you're invested in Apple by a lot, we're not going to invest you in
Mhm.
Apple here because it's not in your best interest, and they have the fiduciary
Yeah.
responsibility to do that. And then, so that's the number one answer. And then, if you happen to pass away, you don't want your family members, especially if they're not financially uh, illiterate or whatever, capable. You don't want them bouncing around the institutions trying to figure out the money situation, and you're passed away.
Mhm.
You want it at one institution.
Yeah.
Yeah.
That makes sense. So I want to kind of, well, there's a couple things you said that I want to kind of brush on. One is the diversified accounts, right? When you're investing. So when I remember that was one of the first things when I started having you looking at my accounts, the first thing you did, you said, Monique, why do you have all your money? And I don't know if it was like the government, I don't know, it was like one big, it was
Yeah.
like, you know,
It's
the
like a
pie
fund
chart.
or
It
something
was
like
like,
that.
yeah, I had it all in like certain amount, a certain type of fund.
Yeah. Certain.
And then, yeah, so I gave you my computer, you did your little thing. And when I got it back, I looked at it and there was like a whole bunch of set, like, you know, you split it up in like 8 different ways. And I
Mhm.
was just like, and you were like, it's not smart to put all of your money in the same type of funds. And I just want you to kind of explain that, like, what's the importance of having a diversified portfolio?
Yeah. So that's a great question. So we're talking about investing one-on-one. That's definitely like up there. That's probably one of,
Mm-hmm.
if not the most important aspect, is diversification. So let's look at the extreme example. If you have all your money in NVIDIA, which I mentioned last episode, um, and just NVIDIA for some reason just goes down. It's really volatile. And so now you have all your
Mm-hmm.
money in that one stock. So that's the most extreme example where you literally just have one stock and all your money in there. And so all your money is going to go down. And then on the other side of the example, if you're very well diversified, but you do have NVIDIA in there, if NVIDIA goes down and have a horrible day, you still have everything else working for you and bringing it up. So it's not going to go down as much. It's only going to go down
Mm-hmm.
a certain percentage, whatever the percentage of NVIDIA you have.
Okay.
And so you don't. It's not that much. It's not that volatile. That's so.
Mm-hmm.
Especially if you want to retire, you don't want your money just going down. And for example, like on a bad company that might like go out of business or something, then all your money, they went bankrupt, all your money's gone. Anyway, so you want your money spread out. So that's one. And then the second thing is
Mhm.
So we need like 30 to 40 stocks to have our money in to be like considered diversified. Not only that, it shouldn't even be in the same
30 to
sector.
40?
Yeah, it shouldn't even be the same sector. So it shouldn't be like in a finance or tech or industrial. It should be spread out amongst those, and it should be spread out globally. So not all your money in the United States. It should be spread out to other countries, emerging
Mhm.
markets. So that's like the perfectly well diversified portfolio. And so that's when I did yours. That's what I did for yours. It was tied up, and I just spread it across countries. I spread it across industries, small stocks, big
Mhm.
stocks. So like it's not going to get hit that hard. So diversification is very important.
Okay.
What was the
Wow.
other thing you had?
I honestly forgot. I think I forgot.
That
So
water.
it's like,
There's water in there.
I don't know,
Hard
you know
self
me. No,
now.
I was kidding. No, so okay, so what makes a good portfolio? So it's the diversity. That's what makes a good portfolio. Can you explain like what a portfolio is? Because I'm pretty sure, some people probably don't know what that is.
Yeah.
So
So
like when you're going in and you grab somebody's account, like I come to you, boom, Johnny, I want you to manage my account. What is like the first things you start looking at when you're looking at their portfolio, like to start, making sure it's a good portfolio and what moves or changes you want to make?
yeah. So I would definitely say whether it's diversified. That's the first thing I'm looking at. If it's all tied up in
Okay.
one thing, and then get more specific to what are they actually invested in. So if they're good
Okay.
stocks, so we should always have some solid stocks. Maybe that might not grow so much, or maybe not even stocks, but like different kind of financial instruments. It doesn't have to be
Mm-hmm.
stocks; it could be bonds. Should have some that are not going to fluctuate that much. Like they're not going to go up or down a lot, so they're more stable. And then you want some that
Okay.
are right, like you want some heavy hitters in there that's gonna bring your stocks up. So like small companies that have big potential, you want that in there as well. So that's a good portfolio.
Mm-hmm.
It's diversified and it has some strong companies there, and it has some stable investments as well.
Yo, so everyone take a moment, hit that subscribe button right there, yeah, down below. Subscribe, like, and share. Follow us on Instagram and Twitter at investment underscore talk underscore only underscore MDI. Yes, that's the name. And definitely hit us up in the DMs. Or you can email us at admin@mdinvestmentsllc.com. We definitely want to hear from you. We want your questions. We want your feedback. So hit us up. Anyways, let's get back to this money investment talk only. What's the difference between, so you have stocks, you have bonds. So
Hmm.
you mentioned to have some stocks and some bonds. What's the difference? And then why is it important to have both? And then which one should you have more of?
Um, so bonds is a little bit more complicated. So let's go with start with the stocks first. So stocks is like you have a ownership in a company, like a Microsoft,
Mm-hmm.
whatever. They issue out shares. Let's just call it 1,000, for example. If you buy 100 shares, you get to buy it. Then you have 10% of the company. So you have a portion of that company that you own, and the benefits of having those shares is you get to reap in their profits. So as they grow, especially through dividends, then your shares grow with you and you make more money. Um,
Okay.
bonds are debt obligations from a lot of time like states or governments, and they
Mm-hmm.
use it to like build or for whatever the needs, like to run the government. So like to build highways, for example, they'll use bonds, and
Mm-hmm.
basically you could participate in a loan in that loan, and they pay you in
Mm-hmm.
interest. And so uh, the the value of those bonds don't fluctuate that much because like the governments they're always going to pay pretty much. So like those are good investments to have like that stability. So I think of stocks as like a football on a football team. Stocks is the offense, and bonds is the defense. So you want something that's gonna put on points on the board. So you need those stocks to help your portfolio grow, but then you need some defense for stability and to be more like conservative. So the traditional kind of ratio of stocks and bonds is like 60% stocks and 40% bonds. I think it's more going towards like stocks now. So a lot of people might be like doing 65 or 70 stocks and then 30% bonds. Just because stocks just are better. You get more profits. And if you're feeling like really risky or whatever, you could just do 100% stocks.
So I know I have so many questions, but you mentioned dividends. That's money that the company pays you monthly, and then another question, do all the companies do that? And then do all of them do monthly, or do they do like weekly?
No,
Stuff like that.
they usually do quarterly. That's pretty much across the board. I think you can vary from there, but I think quarterly is like the kind of like the standard. So every
So they
3
pay
months.
you?
Yeah, so they pay you like a percentage. So sometimes they'll like a company will say, hey, we're gonna pay 6% dividends for our stock. So whatever the price of the share is, like I said, 6% times that's by 6%, they're gonna pay you that directly in your account. So that's dividend. So yeah, you pay. So there's 3 ways you can get money from a stock. Talking about stock 101, there's 3 ways. The price could appreciate. So it could go from $50 to like $55. So now it's worth more. That's how you get money. Then dividends, as we're talking about. So you keep that money, it keeps on growing. You get that 6% every quarter. You get money.
I have a question. Say 6%. So is it 6% of just one share, or say you own 100 shares, so you get 6% of each share that you
Yeah,
own?
each share, yeah, times the amount of shares that you have. Yeah, so a lot of people, they just like the passive income. They just literally just buy stocks just to get the dividends. And then the dividends give you the money to buy more stocks to get more dividends. And then it just keeps on going.
You know what's so funny? I'm that you said that because so do they give it to you in your buying power?
No, it's directly in your account. Like it's cash money, straight cash, homie.
Oh, straight cash, homie. All right.
Straight cash.
Okay, so that makes sense.
Yeah. Oh, so and the third way.
Okay.
This is like more advanced. So I'm about to give y'all a gem. Because people only think like, oh, that's the only way is the appreciation or the dividends. But there's a third way. If you don't do this, then you're irresponsible. And it's a little bit more advanced strategy, but look it up, Google it. We'll cover it in another episode. But it's called covered calls. When you sell covered calls, so basically you have the stock, and then it's basically you sell a call, which is an option of the stock, and you're basically betting on it that it's gonna continue to go up, the stock. Because anyway, so it's like monthly income or monthly rent. If you have a house and you rent it out, you get that monthly rent. It's like it's always income. So when you sell a call, you're selling of the same stock that you have that you own. You're selling all of it, and then you're getting monthly income.
You're selling the call, like so you're selling, like you're basically betting if the company's going to do well or if the company's going to do bad.
So you're betting on it. Well, I don't like to use the term betting when it comes to investing. I know a lot of people think that, but it's like if you don't know what you're doing, yeah, then it's like gambling or betting. So you're thinking the stock is going to go up, and that's the reason why you have it in the first place. So the call option is you're selling it so that you could get income from it. So whenever you sell in anything in life, you get money from it. So you sell the call option of that same stock, and yeah, with the thinking that it's going to go up. And so as you're getting money from that stock, so let's say you paid $100 for it. Since you're getting like $10 a month from it, the actual price that you pay for it goes down. And then if you do that for 10 months, you actually got the stock for free. So that's good. And then you just keep on doing over and over
Mhm.
and you're making money over it. So like I said, so you get the stock for $100. Let's
Mhm.
just call it $120.
Okay.
All right. And you sell calls for $10 each month. And
How do you do that?
it's in your brokerage account.
Oh.
With the options, you hit trade options, sell the call. It's called a covered call strategy. You can Google it.
Okay.
Investopedia would explain it very well.
Okay.
So like I said, you selling calls for $10 a month. You do
Mhm.
that for 12 months, a year. You just got that stock for free. And so like you already broke even. Like you're whatever
Mhm.
happens next, you're profitable.
Okay.
So people who don't do that, and then you get the dividends on top of that. Man, there's so many ways to make
I
money.
know. I see that. I'm like, all right. I learned like so. You talked about three. What about shorting? Isn't that another way, or that's just a strategy?
That's not
Oh,
especially with
okay.
one-on-one. That's not the one-on-one strategy.
Oh, that's more like a
Yeah, it's advanced.
day
Okay.
trading level.
Yeah,
That's another episode.
that's like episode 10.
Oh, okay. I'm like over here trying to swim before I can't even paddle.
Yeah.
All right. So, all right. So you have the three ways that you can make money in stocks. What are some other tips for people who are just getting started? Like just
Um,
learn.
yeah, so I'll say, do it only like great companies. Do your research. If you're not the type to want to like research yourself, I'm not the type to do that. Do what the analysts say. Your brokerage, if they have like a buy rating, if the consensus is buy rating, then do it. Um,
Mhm.
invest in good companies that you know that's going to be here 10 years from now, and don't look at the stocks every day. Like look at it like once a month. Like,
Yeah, and I know that's a big. So that's a big one. So especially when COVID first started, and then you started seeing like everything dropped. Like I remember my 401k went that I was like, it's like negative. I don't even remember, but and then every day I look at it, look at my other broker child, look at it every day, and I'm like, the money's going away, you know?
yeah,
And it makes you nervous because you look at it every single day, but it's like just let it sit. But that's if you're a long-term investor, right?
yeah, which is like invest on one-on-one. Yeah, you want to do long term. You don't want to worry about this swing trading and day trading. If you're just starting investing, you just want to kind of focus on a long term. Yeah.
And swing trading is where you're like moderately trading, right? Like you don't
Yeah,
trade.
so like long term is like 5 to 10 years out. Like
Mhm.
you're gonna buy a stock, you're gonna hold it for 5 to 10 years.
Mhm.
Swing trading is like if you want to hold it for like a few weeks to a month, and you're just looking for those dips that's gonna happen, and then sell.
Mhm.
Yeah, so that's the difference between swing trading.
Do
It's
you
just a time frame thing.
do you ever do those? Because I know you do day trading 100%. Like, well, for your main income, but do you ever do swing trading on certain stocks and long term?
Yeah, I do. I do it all. So I do the day trading every day, and
Mm-hmm.
then if I think a stock is gonna like do something the next week, I just don't know. In a few weeks or so, I'll do the swing trade, like off the patterns and whatever. So yeah, I do it all, but most of my money is in long term.
Okay.
Yeah, most of my money
But most of it isn't long term.
is long term. It's in
Is long.
long term. Mm-hmm.
Oh,
And
okay.
options. Yeah.
Interesting. See, I would have never. I thought most of your money was in the day trading, the short term.
No, that's how I get a lot of the income, but
Mm-hmm.
a lot of like the
And then you
heavy.
transfer it and put
Yeah.
it to. Oh,
And
so it's
one thing I want to, so another thing people always ask is like, what is a good like profit? What is a good return?
yeah.
Like when we start, like, what do I like? Am I even doing good? So
Mm-hmm.
the most easiest answer for that, there's a few answers. The most easiest answer is if you haven't lost any money, then you're doing good. Like you made profit. All right.
That's
If you want to do a little bit better than that, go to the next level is are you beating inflation? Which is
what's
about
inflation.
it's the overall cost of everything, like the economy. So
Okay.
um the rising of it. So from year to year, the cost of everything like gas, fast food, clothes.
Like how we're always like, oh, I remember back when I first started driving, gas was like $1.25, and we were riding around with our friends, not worrying about nothing. And now, and then someone would be like, "Oh, I'll give you $5 for gas."
Yeah.
And you're like, "All right, cool." And now they're like, "I'll give you $5." And you're like, "Nah, like that's not even. It's not gonna get me anywhere." So
Yeah,
it's like
it-
basically
so it was funny. You made me think. In the middle of COVID, I think gas went down like so much,
Mhm.
and there was a meme that said, $5 is now gas money again.
Yo, for real. For
Remember, it
real,
was
like
like if you wanted somebody to take you somewhere, you gonna give me gas money?
yeah. Like I remember, like in high school, and first when like me and my friends would ride around, and I'll be taking mommy's car before she bought me my own car. Just taking mommy's car, we'd just be riding, doing nothing, just listening to music, thinking we were like whatever,
Mhm.
just doing nothing. And then as time got on, and then like as we got a little bit older, like we stopped doing. Well, we got older, but it was really like, yo, we don't have money to be
Yeah,
putting. You know what I'm saying? Gas is like $3 now. I'm
yeah,
not riding around like we're gonna pick one location, we're gonna stay there, and that's it.
yep, yeah. Five
So
dollars gas money. That cracked me up.
that's
Um,
funny.
yeah.
So okay, so that makes sense. So inflation goes up. So that's what inflation is to give
All right,
you an
yeah. So
indication.
that's the next level. Are you beating
Okay.
inflation?
All
Which
right.
inflation averages about 2.5 to 3% a year
Okay.
on average. So you kind of want to beat inflation. That's kind of like the goal at the minimum, because you want your money to keep up with the cost of stuff. So that's
Mhm.
obvious. And then so you at least want to do that. The next level is like what you would expect from a financial advisor. All right, so I go to a financial advisor as we talked about earlier. What should
Mhm.
I expect from them? What's like a good uh so there's two numbers. So the solid number is like 6 to 15%. I guess
Mhm.
is good. But if they're beating the stock market, is even better. So the stock market is usually measured by the S&P 500, which is the top 500 stock companies uh, in the market. So
Mhm.
what is their percentage? So if they're like averages like 8%,
Mhm.
returns, and then your financial advisor is getting you 6%, you're like, oh, hold on, like the whole market is averaging 8%. Like, what are you doing? You're doing worse than the average.
Yeah. Yeah. That's where their auditor has to come in and be like, "Yo, what are you doing?"
Yeah, what are
Like,
you doing out here? Like,
okay.
yeah, what are you doing in these streets? Like, so yeah, so you're beating the inflation, but you're still under the market. So you're like, I might as well just put my money like in a random like ETF, the SP 500 ETF. I'll get better returns. So that's another barometer, right? So
Mhm.
16 to 15%, or
Okay.
if you're beating the stock market. I say if you're above 10%, you're living a good life. But then
Okay.
we're gonna go to the next level on here is where you're getting minimum 200%.
200%. Look at that. Minimum 200%. Yo, that's like quadruple. No, I'm not even gonna say that because I'll make myself look dumb. But basically, that's like more than doubling your money. Basically,
It's doubling your money. You
it
just
is.
times it by two.
I know that.
So 200
I
times two,
swear
you
I'm
double your
drinking
money.
water. I swear there's water in there.
Yeah, I'm drinking water too.
You a lie. Um.
Uh,
Okay,
but yeah,
so
so minimum 200%. That's what we do here. So if you ask the people in investment talk only, which is our chat that we made that evolved into this podcast, we will
not
be
just this podcast, it evolves into your business. You open your own business, and then
yeah
the podcast is just a little entity of the business that you have. You
yeah
just want to kind of quit. So
yeah we'll be discussing at like the 15% that I mentioned, the highest. We would never
yeah,
do a financial advisor, and that's what we're trying to do. Is like I would never advise anybody more to go to a financial advisor because I say now we can have more. Not that
hmm
they're doing bad or wrong because they're doing their job,
yeah.
but we
Like
can have more.
you can have so much more that you can literally just work for yourself. That's like what you did, right?
Yep.
You were like deuces to the 9 to 5, and
Yep.
now you literally work for yourself. And
Exactly.
that's such a great accomplishment. I'm so proud of you. I'm having a big sister moment here. That's dope. And maybe one day I'll make that move too.
Oh yeah, you will. We got you. So
Yeah.
we're running short on time. We need it. You got something else?
I wanted to just because you need to do stock of the week. I
Mm-hmm.
just wanted to talk about one more thing. So you know how you buy stocks and companies, because this is just something I'm thinking of, things that I've went through. You said go to ETFs because you mentioned ETFs. Why do you feel like you should buy an ETF over an individual stock?
Yeah. So
What is an ETF, basically?
an
First.
ETF, it stands for Exchange Traded Fund.
Mm-hmm.
So the key word there is fund.
Mm-hmm.
So a fund is a basket of stocks. So we have one stock, which is like we say Apple,
Mm-hmm.
um, and a fund has a whole bunch of stocks. So it has Apple, Microsoft, Nvidia, Intel, Mastercard, Visa. So it has all those that you can buy,
Mm-hmm.
and that makes up the fund. And basically, ETF is a fund where you can trade it just like a stock. So
Okay.
I can buy it this second, trade it the next second, just like a stock. Because not every financial investment has that where you can just trade it. You can get in and out of it easily.
Mm.
A stock
Okay.
you can, it's liquid. So ETFs are liquid, but it's a fund. So
So
the reason
basically, you're
why,
getting a little piece of all these little companies. You're
Mhm,
putting it together in one little thing, and this is the stock you're buying. This is the one share, but it's a
yeah,
little piece of all these little companies, rather than just solely buying Apple, solely buying Microsoft, solely. So you're buying Apple. I'm just throwing out numbers: $200 for Apple, $200 for Microsoft, $200 for, and then instead you're just buying one stock that's $200, and you have a little bit of all these companies.
exactly.
Okay, so why is it important to you suggest to buy that rather than the individual companies itself?
So going back to our prior discussion is diversified.
Mm-hmm.
So if Apple goes down, you still have Microsoft, Nvidia, and all those I mentioned working for you. So it's
Mm-hmm.
less volatile. So in a time of correction, which we're in right now,
Mm-hmm.
where the stock market goes down 10%, and pretty much every big company, whatever, all the companies across the board are going down about 10%. The ETF is probably going to go down like 7 to 8%. So it's less volatile because it's
Okay.
well diversified. Um, and then just because like so you have a finite amount of money, and you say I don't want to put all my money in Apple. I think Microsoft is going to go up too, and I think
Mm-hmm.
Visa is going to go up too. So you want to
Mm-hmm.
be a part of all that. You don't want to just put your money in one thing. So it's like if I think all are going
Agree.
to go, I want to be
Agree.
I want to be in all those parties, not just one party. So
I know
yeah,
you're married or whatever, but that's basically like dating, being single. You don't put all your
yeah, you don't, yeah,
in one basket.
exactly. Yeah,
So
that was a long time ago. Yeah.
all right, so let's get to stock of the week. I want to see what you got.
All right. So stock of the week.
Okay.
And I really like this one
You
because
said that last week
speaking
too.
of,
But you said that last week. You said I really like this one.
I know, but I really like this one, and I think
Okay.
a lot of people gonna like this. This is a household name, and
Okay.
it's Tesla. And this week they're actually it might be this week or next week. They're actually doing Investor Day,
Mm-hmm.
and so it's like this like big I guess it's almost like so Apple's events where they do a big like event about what they're gonna talk about. Anyways, they have Investor Day, and so people are waiting to see like what they're gonna talk about. But one thing I know that what they are gonna talk about is that they have this battery. So like one of our cars, the traditional car, if it hits
Mm-hmm.
100,000 miles, you're like, oh, now I gotta start watching it. If it
Mm-hmm.
hits like 200,000 miles, you're like, hey man, I need to just ride it
Not
up.
Hondas.
Yeah, get the
Hondas.
best.
Hondas be 500,000 miles. No, I'm just playing.
Yeah, like I need to get the best out of everywhere I can because it's probably any day now. So
Yeah.
their battery, they're about to have this car 1,000,000 miles. So we drive 1,000,000 miles.
1,000,000 miles.
1,000,000 miles. And they have this so they're extending the life of the battery so you don't have to charge it as often. So that's
Mm-hmm.
two things. Um and a lot of more companies are coming out in the electrical car
Mm-hmm.
industry. Tesla's the only one that gets data directly from the cars. So they have more data to improve on their product. And then not
Okay.
only cars, they have a whole bunch of other products.
Mm-hmm.
They're about to they're outsourcing their technology, so their patents are open source.
Mm-hmm.
So they're going to start charging other companies for their technology. Um,
Mm.
and it's at a
Kind of like
discount
my
now
company.
because, huh?
That's like my company. That's what they do.
Oh
They
yeah.
like
Oh cool.
the government and the military for our ideas
Yeah.
and stuff like that. Yeah, we're
So
actually talking about that today. So that's funny you
nice.
said.
So basically, there's a lot of reasons,
Mm-hmm.
and I didn't even say nothing about the stock. There are a lot of reasons just to like the company.
Mm-hmm.
Like in the next 5, 10 years, it's gonna be great. And then talking about specifically about the stock is that it's been going down. And I know people,
Going down.
it's been going down. So it's a sale. Whenever you sell at the store, you go to the store, you buy that thing, right?
Right.
That's how we need to do about stocks. You pull out your wallet for a sale, you need to
Uh-huh.
pull out your wallet when that stock goes down, if it's a good company, and start buying
Mm-hmm.
more. So it's been going down. That's when you gotta start
It's
buying.
been going down, so you buy now, and then once they come out and they do that investor, everybody's gonna be on it, and it's gonna go shoot up,
Because
boom,
by the
and then
time you hear about it, it's
uh-huh.
too late. Like the price is already up. You want to
Mm.
buy when it's
So how
going
do you get
down.
this information? Do you do research? How do you know like what's going on?
No, you follow you do. There's analysts that put out analyst reports. Actually,
Mm-hmm.
so it jumped up the other day because of analysts found out about that data thing that I just said.
Mm.
So analysts, they meet up with management. They talk about the company.
Mm-hmm.
They put out these reports, and then one of the analysts said, "Oh, they're getting data from the cars themselves." And then people, the price went up. So you read
Mm.
analyst reports. You just do your homework. It's like a full-time job. You just gotta. It's not a full-time
And you
job.
gotta listen
Like
to
enjoy.
them.
You gotta be in it. Like you just gotta be in tune with what the stock market's doing.
And you have to like a lot of stuff is like with the news. It's kind of like with the trends, like you know how you see these social media trends, everybody's on whatever song that's popping, and then it's gonna go up because everybody's in it. It's like, and then it's hot at that moment. You want to go in and try and get it before it blows up, and
Exactly.
then the next best thing is gonna come up, like in the news, like the next best whatever,
Yeah. Yeah.
like for example, like every year there's a Tickle Me Elmo or whatever, the famous toy that everybody wants to get. So you start hearing the little whispers about it. You go in, invest in that product. Everybody's going for it. It's gonna shoot up, and then eventually it's gonna die down. And right before it dies down, you sell. Boom.
Yep.
That's dope.
But yeah, so Tesla stock of the week.
Tesla
All right.
stock of the week. So we'll see. And that's for like a long term like thing.
Yeah.
Like buy
Yeah, it's
now.
like a long term. Yeah, it's like a long term buy. Yeah.
Okay. Exciting.
All right. Well, it's been great. Until
All
next
right.
time.
I know. I'm so excited. I think this one was great. The investment 101, because first of all, guns and butter, you get the mindset. You know what I'm saying? So your mind, you have to change your mind, and then you want to start investing. Investment 101, you have the basics, you start getting your stuff together, and then you start diving a little bit deeper into
Exactly.
what we're doing next. And then, so I know we talked a lot about stocks on here and bonds, whatever, but that's not the only way to invest. There's so many avenues you can take, real estate, etc. And I think that's one of the avenues I want to get into. I know I do the stocks and stuff like with you or whatever, but I want to really get into real estate, like buy an investment property, like a condo on the beach or something.
Do an episode on it.
And that's what I was gonna say. I was like, so we need to get somebody on here, like maybe next episode or something, and let's talk about real estate, like how to even get started, how to get your foot in the door, because that is one I'm definitely gonna be taking notes on. So I would like to bring a guest on here, for us to do that.
Let's do it.
Yeah, so for sure. So definitely make sure you subscribe and you like. If you like what we're saying, share it to whoever needs to hear it. Definitely subscribe so you can get those notifications. when we have our next episode.
Yeah, and if you dislike, tell us why. We want to know.
Yes, if you dislike, be like Monique says yo a lot or something. I don't know. Just whatever it is. I'm here for all types of feedback. And this is for everybody, just to benefit. It's just a benefit. There's nothing like we're not gaining. We're just having a conversation and making sure that everybody gets, you know, all of Johnny's gems, as he calls it. Drop the gems that he's dropping. You know, so it's just information. So you could take it, do what you want to do with it. I know it took me forever to actually listen, you know, because he's my brother, he's my little brother. But then I started really like seeing things and, you know, just seeing how he moves. And I'm like, damn, I want to be like that too, you know? No, it's the truth. I'm like, I want to be able to just, and I started change my mindset, and then just started really researching and investing and trusting my brother, trusting and listening to other people and surrounding myself with people who are knowledgeable in these fields, you know? And then now I'm nowhere in a position, like I was never in a bad position, but I'm in a way better position just because I'm actually taking the knowledge and doing something with it. And then doing research on my own as well. I'm always hitting him up about questions and all these questions. Like none of this is scripted. All of I'm just thinking like, oh, okay, what about this? What about that? What about this?
No.
So, and that's what we want from you guys. Like hit up the email, the DM on Instagram, all of that. So,
Yep.
All right, Johnny.
All right, until next time. Investment
Till
Talk
next
only.
time.
I've been Johnny Ruiz.
Show me the money. Investments are only. We keeping it coming.